Hi guys, welcome back to the YouTube channel. Thank you for watching my previous video on CPF and the different annuities and different options that were in the CPF Life versus the annuities option. I was watching Young's latest video and he talked more about self-managing, and a lot of people ask about self-managing their own CPF money after 55, withdrawing that amount and then investing it in themselves for themselves. And in this video, continuing along the lines of CPF, I would like to talk more about what I would do if I'm 55 and I were to self-manage the pot of money. So I understand that policy risk is a thing, so a lot of individuals might think of withdrawing that amount of money from CPF. Let's say you already have the FRS in your CPF life and you want to withdraw the excess. In the previous video, we talked about 213,000. So I'll continue along that lines in this video. And in this video, I'm trying to answer the question what I would do if I was 55 years old and withdrawing this excess $213,000 from my CPF account, and what the options I would consider as an investment analyst. Now for some slides that I created. If you see me looking at this side, of course my screen is here. So CPF Life versus self-management of the funds. So a short disclaimer here again, this is for educational purposes only, it's not investment advice. Of course, everyone has their own background, their own situation to take note of. You should really consult a financial advisor for that. Today's video is only what I think is appropriate in my circumstances, and I'm projecting, of course, if I'm 55 years old and what I would do. Also, something to take note, a lot of people might think, withdraw the money, buy an insurance policy or ILP plan. So I'll not talk about insurance plan in general for this video, just because I'm not talking about annuities here. I'm not talking about funds related, so equities related investments for this portion of money. And for ILP's case, as you can see in here, management fees are 1.5% on the fund level itself. So I'm not even talking about supplementary charges. I'm talking about fund level charges that all the ILPs or some of the LPs charges are a lot higher than some other options I'll be talking in the video. So as you can see, this is an AIA fund, Global Focus Equity Fund. The management fee on top, as you can see here, is 1.5% per annum. So this is every year you need to pay this management fee for them to manage your money, your pot of money. And in the Pru Global Equity Fund here, it's also 1.3% per annum, right? The continuing investment charge, which is like management fee, and you pay that yearly. So 1.3% and 1.5%. Another reason why I don't fancy ILPs or don't really like ILPs is because they are sort of active managed versus passively managed. And there are a couple of studies here and there over the last few years saying that active actually underperforms passive in the long run. As you can see from the two charts here, this is the same case for these global funds that I'm looking at. AIA's case, I think for the last 10 years, maybe it outperformed the index, but since inception, so we are talking about a longer period of time, right? So I'm looking at the longest period of time possible. Since inception, the AIA fund performed 3.96%, while the benchmark or the index that they are benchmarking this to is at 4.62%. So quite a bit of underperformance here. On the second chart here, or second graph here, you can see the Prudential Global Equity Fund. If you see from a bid to bid level, since inception, it performed 3.1% versus 5.1% on the benchmark, which is a 2% underperformance for a very long period of time. If you take that into account, that's quite substantial, right? If you take, for example, in Pru's case, the fund underperformed by 2%, and there's a 1.3% annual investment charge. I believe the investment charges are not accounted for. So add them both together, it's what, 2 plus 1.3%, so it's what, 3.3% underperformance. If I'm mistaken and the fund charges are already embedded into the fund itself, a 2% underperformance is extremely large. Over a long period of time, like 20-30 years, the 2% will really add up, giving you really distorted returns or underperformance here. And the amount that you can withdraw from the investment subsequently because of 2% underperformance every year, it will be quite large. So that I don't really fancy ILPs, and I'm not going to talk more about them, but this is another option some people might consider. So what am I going to consider? I'm going to consider ETFs and funds. And for a more diversified portfolio, I'm looking at the MSCI World Index or their equivalent. So today I'm more looking at MSCI World Index or its equivalent. The reason being, it's a very broad-based investment strategy or investment index where it has about 1.3k different investment equity. And the reason why I'm looking in the MSCI World Index is because it has about 1.3 thousand different constituents inside the index all across the world, so it's very diversified. So that's why I'm choosing that. As you can see from the returns, since 1987, it returned about 8.56% per annum. Since 1987. In my model, I'm assuming a 6% instead of the 8.56%, just to be a little bit more conservative in my model. So I'm just using 6%. And for the fund component, I'm going to use Endowus and POEMS just because they have the Amundi index MSCI World. This is the fund that tracks this index. So this fund is a passive index, meaning it just follows the constituencies of the MSCI World Index and just invest accordingly. Another reason why I'm choosing this fund is because there's a very low management fees for this. As you can see here, it's 0.1% management fees. Of course, because it's a global equity fund, it has many different countries in there. So there's 23 developed countries in this index. So over here, I'm just breaking down the different fees that each platform charges. I'm also putting IBKR here, so interactive brokers, just to give you a sense of buying a unit trust or fund versus buying the ETF equivalent for MSCI World Index, right? As you can see, brokerage fees, POEMS charges a 0.06% to a 0.08% for a one-time fee. Of course, Endowus, no sales charges, so that doesn't apply. For IBKR, it's 0.05 and so one time. Platform fee, the good thing about POEMS is there's no platform fees. For Endowus, it's 0.3% platform fee for Fund Smart, and for the multi-portfolio approach, there's a 0.6%. The more appropriate one is the 0.3% per year for the platform fee, because I'm just going to do an apples-to-apples comparison for POEMS versus Endowus just for the MSCI World Index. So it's only one fund that I'm looking at, so it's not the multi-portfolio that the Endowus Robo-advisor uses. The management fee for the funds is 0.1% per annum for the POEMS and Endowus. So it's the same fund that they are using. For IBKR, it's 0.12% per year. That's the little bit of the difference there. Total annual, POEMS is the cheapest option here. You can find it's 0.1% versus Endowus is 0.4%. Another quick note here, I'm going to assume that I'm going to withdraw the CPF amount as cash component, because another way to do it is, if you got the money in CPF OA, you can leave it in there and invest in POEMS and Endowus. So POEMS and Endowus actually has the CPF OA investment option where you can use their platform. But I'm not going to use that. I'm just going to say the cash component. But just a quick note here, CPF OA is an option. So I know different individuals have different risk appetite, different worries and wants, right? Maybe a reason why people want to keep it in CPF OA is because they are afraid of getting scammed. Scams are really prevalent nowadays. So leaving at CPF OA just gives people the comfort. But then there's also policy risk if you live in CPF OA, right? Looking at Sri Young's video, he mentioned that over the last couple of years, CPF did go and change a couple of the different parameters on how you can withdraw, what age you can withdraw, of course. So that's something to take note, of course, for policy risk. So, to combat the policy risk, I'm just saying, withdraw at. So for the next few illustration purposes, I'm assuming that I withdraw my CPF amount at 55 and just projecting it from then on. So here are the projections for Endowus and POEMS. For Endowus, because there's a little bit more drag, right? 0.3% extra fees that you need to pay per annum versus POEMS where there's only the 0.1% annual charge. For Endowus, there's the 0.3% plus the 0.1% annual charge. As you can see, the difference is quite substantial. I'm assuming at 55, I withdraw this $213,000 and invest it in Endowus and POEMS through the Amundi World Index Fund. So at the end of 65, Endowus will give us a total portfolio value of $369,000, while at 65, the POEMS portion will give us $377,000. There's about $8,000 difference here just because of the extra 0.3% platform charge that you need to pay for Endowus. And over the next 20 years, same thing. And at 85, I'm going to assume I'm going to pass on and pass it to my family. For Endowus case, it's $369,000 and POEMS case is $401,000. For the distributions, I'm assuming a 5% withdrawal rate. So I know a lot of people have heard about a 4% withdrawal rate, but I'm just using 5% withdrawal rate here just so that I can do a more apples-to-apples comparison versus CPF Life, where CPF Life we put in the $213,000 extra, you get about $18,000 in yearly distributions. So just to equate that, for about $18,000, that's about a 5% withdrawal rate per year. So the difference between the Endowus and the POEMS portion, in Endowus, you will be able to withdraw $18,000 to $19,000, but in the POEMS case, you withdraw $18,000 to $21,000. So quite a little bit of difference, especially in the tail end of the thing. As you can see, the fees and charges that the platform has is very important because it compounds every year. And at the end of the day, the total payout for Endowus is $747,000 and the total payout for POEMS is about $800,000. Quite a substantial difference, $53,000 difference between the two, just from extra 0.3% per annum charge. Over here, I'm just comparing everything to CPF Life. In CPF Life, you put it in your RA at 55, the $213,000. At 65, you get an $18,000 payout per year. At the end of 85, you get a $95,000 payout for that bequest to their family. So for the total distributions here for CPF Life is $465,000, Endowus $747,000, and in POEMS case, $800,000. So the difference here, as you can see, is from the projections, of course. The projections for the MSCI World Index that I'm using is 6% per year. So versus the CPF Life, where it gives you about, if I remember correctly, it's about 4% or just slightly below 4%. So yeah, that's why there's a large difference between the CPF Life component and the POEMS component. Of course, all these are projection. Past performance is not indicative of future performance. So 8% versus 6%. For the MSCI World Index. You never know for the next 20 years, 30 years, what the performance is. Of course, CPF Life is also a projection. Some might argue, of course, that it's a more stable projection because it's sort of like a government program versus a variability of the markets in general. So that's my comparison between CPF Life versus a more self-managed approach using POEMS or Endowus, and the different payouts that I would expect when I turn 65 years old. Of course, the portfolio selection here of just purely using MSCI World Index might not be the best for myself. If I turn 65, maybe I will want additional bonds in there or additional bond funds in there just to make it less risky of an investment. Equity at that age, one can argue that it's a little bit risky just going for 100% equity here. But the reason why I'm choosing 100% equity here is because there's still the FRS amount in CPF Life, so that will give me a steady yearly distribution as well. And this additional top up here is on top of that CPF Life amount that I will get above CPF Life. So additional $18,000 is pretty good. This also will give me the flexibility of withdrawing more as well. As you can see, the additional death benefit is $400,000 here. So it gives me the flexibility to say, hey, if I need more money per year, I can withdraw more as well. Or if I see that my yearly expenses won't hit that amount, I can just leave it in the portfolio and let it ride and let it compound even more. So this gives me a lot more flexibility between 55 to 85. If I want to withdraw that amount, if I got a large expense that I need to pay with future kids, right? Maybe I want to give them a little bit more money, or just different life situation where I see like, oh, okay, maybe there's a great investment that I want to do. So it gives me the flexibility of withdrawing an additional amount. At end of 65, I will have $377,000. So between 55 to 65, I can withdraw that amount anytime I want. And between 65 to 85, it gives me a more flexibility either to, number one, leave the money in and not get a yearly distribution to let the money compound, or number two, let me withdraw larger amounts of yearly distributions. And thirdly, between 65 to 85, if I ever need a lump sum amount of money, I also have the flexibility of withdrawing that lump sum amount of money, for various life situations. Maybe my family needs more money, maybe I want more money. So that gives me a lot more flexibility there. So yeah, that's my analysis of self-managing a CPF amount at 55 years old and why I might think of withdrawing that amount of money. Just because, number one, it gives me more flexibility. Number two, potentially higher amounts of distributions. Or number three, it can also help to mitigate policy risk. Maybe down the line, CPF might change how they allow withdrawals, for example. So this gives you the option. So by withdrawing it at 55 and then investing it in a self-managed way, that will give me the opportunity to mitigate that risk as well. So that's the end of the video. Thanks for watching, everyone. If you have any other comments or questions regarding this approach on investing the CPF life monies, please let me know. If you have any questions about CPF life in general, leave it in the comments below. I'll try to answer it. I know in the previous video, there were a couple of other questions about CPF life, so I'll also try to answer those in the next coming videos. So thanks for watching the video. Please like and subscribe and stay tuned for the next video.